When we first started out as financial planners, we were called registered reps way back then, and there was no fee-based planning, or people didn't even know what a financial plan was. Wow, has the world changed since then? But bear with me for just a minute. Back in the day, well, there were stocks, there were bonds, there were options, there were mutual funds. And for investors, it was pretty simple to understand that if you bought a stock, you own that exact stock. And if you bought a bond, you own that exact bond. And if you bought a mutual fund, yes, you bought a basket of some of each stock out there, depending on what that fund's prospectus said. The thought at the time was that it made sense to leave the management of these assets up to some proverbial mutual fund manager in the sky who was doing it full time. And that was about 20 years ago. And when we went through the first good-sized economic recession in my young career way back in the 2000s, the markets took a big hit and then proceeded to recover over a 4 to 5 year period of time. As the markets were hitting new highs, people expected their investment portfolios to also be hitting new highs. And what I saw firsthand was that many mutual funds didn't recover as fast as they had dropped, and investors had not recovered their losses. In looking at the choices the mutual fund managers had made, it became clear that they had not behaved any differently than the general public. They bought stocks at all-time highs, and as those stocks crashed down, they sold them off at significant losses, and then did an incredible thing. They put the money into perceived safer blue chip stocks that not only hadn't fallen as much during the recession, but also they didn't go up during the recovery near as much. Out of that recession came a new breed of investment selections that have become more and more popular each year. And this is the strategy of using what's called an exchange-traded fund, or ETF. The appeal of investing in ETFs is that the investor knows exactly what they're buying. For example, if someone wants to buy all of the stocks in the Russell 2000, which is the small cap US stock index with 2,000 stocks, he or she can buy one ETF that actually represents all 2,000 stocks in the index. On the other hand, if that person wants to buy all 30 stocks that are in the Dow instead of buying 30 different companies, well, that person can buy one ETF now that represents all 30 Dow companies. And wherever the Dow goes, that's what you're going to experience. Exchange-traded funds have also helped investors understand fee transparency, and ETFs have also aided in lowering the overall cost of fees that investors pay on their portfolios, regardless of whether they're actively managed or passively managed by buying and holding. Fees are going lower. So many of you might be thinking, why not just set it and forget it? Like in those old Ronco rotisserie commercials. Remember those with the chicken? You just toss it in there, put on the timer, and set it and forget it until you hear the ding. Well, while there is this thing called market volatility, the majority of investors do panic in market downturns and do make some mistakes, just like those mutual fund managers did during the last couple recessions. They sell off the perceived risky high growth stocks and instead flee to the safety of big blue chip stocks. Or worse yet, they go to cash. I personally believe that when you ask the average investor what they pay their financial advisor for, the answer will be, well, I pay them for market performance and growth of my assets. And if you're thinking, well, duh, Dave, I get that. But the reality is that you're not actually paying us just for that. You're paying us to make sure that you don't make any fatal mistakes, that you don't go to cash, that you don't jump off any ledges or buy things that you can't afford that will mess up the plan you asked us to put in place for you to begin with. And finally, you pay us to be part psychologist and to hold you accountable and keep you moving towards your goals you set for yourself, despite the markets and the socio-economic turmoil that we're experiencing in the world we live in today. So what's the family financial partner strategy, you may ask? Well, for the majority of our clients, where it's financially feasible due to the portfolio size, we do mix in those ETFs we talked about, exchange traded funds, along with individual stocks and bonds, and keep costs to a minimum. But we don't just set it and forget it. We actively monitor and tend to your portfolio, much like a gardener might tend to a garden. There are times when we step back and we admire how things are going, and there are also times when we have to roll up our sleeves a little bit, get down on our hands and knees in the dirt and pull a few weeds. Our goal is that someday you'll get to live off the bounty of that garden as you enjoy the retirement that you have always dreamed of. And sorry for the corny joke. Oops.